of the biggest asks from the government is that it reduce the fiscal deficit by at least 50 basis in the FY24 budget. Ideally 60 basis, because this government's stated objective is to bring the fiscal deficit down to 4.5% in 3 years. That will be 190 basis points lower than the 6.4% fiscal deficit for FY23. This requires at least a 60 basis point cut in the deficit in FY24 to 5.8%. The temptation to give a round figure of 6% must be resisted. Announcing a deficit of 5.9 at least will show determination and will impress foreign and domestic investors that the government is committed to strong macros. If the fisc is tightening, then the Reserve Bank too will not have to tighten much. Secondly, the government must resist the desire to assume as high a tax growth as one is seeing this year. The current year's 17 to 18% tax growth is due to vengeance spending after COVID and higher inflation. Nominal GDP in the current year, that is real GDP plus inflation, has been rising by 15 to 16%. Next year, nominal GDP may rise by only 11 to 12%, with 6% real GDP growth and 5.5% inflation. It may be wise, therefore, to assume a tax growth of only 12% to ensure more investor confidence in the budget numbers. Speaking of revenues and taxes, one can't expect tax cuts in an election year, when the government may actually be keen to spend more. But tax reforms can surely continue. The biggest ask from the government has been that India's complex, even chaotic capital gains structure needs to be reformed. A low-hanging fruit would be to define short-term and long-term identically for all asset classes. There is a demand that higher capital gains tax for high-income earners be reduced. But it would be better for the government to push more steadily towards a personal tax regime with lower rates and no exemptions. Right now, one can opt for a no exemption but low tax regime voluntarily. Maybe the government can nudge the system towards fewer exemptions and lower tax rates. On corporate taxes, the big ask is to extend the low tax regime for new companies by at least 2 more years, since not many new companies have come up in response to the PLI schemes. Much of this is still work in progress, and hence extending lower tax regime to new companies may help more private capex. Coming to the government's expenditure side now, the big request is to refrain from announcing new schemes in a pre-election budget. The BJP may not have to, given its resounding victory in the latest Gujarat election. Also, one hopes the government keeps the momentum going on capital expenditure. Like this year's 26% higher capex spend, it needs to boost capex spend by a further 25% next year to take the budgeted capex to at least 9.5 trillion rupees from this year's 7.5 trillion rupees. The early leaks of higher spend on railways next year is a good sign. The far-sighted scheme of giving states 1 lakh crore of interest-free loans if they spend on capex also needs an encore. The government is approaching the forthcoming budget with strong macros. It must build on them and resist the temptation to dilute them.